Thank you guys for clicking on this week's video. Today we're going to go over the pros and cons of putting on your account on margin. So first we're going to go over the pros. Basically the biggest pro that I see with margin is the fact that you can leverage your assets, meaning let's say you have $10,000 in your account, you're allowed to borrow 50% of your account's value, giving you that much more equity to work with. And one of the benefits I see with that is typically when I have a stock that's trending down after I bought it and I know it's going to go up long term. However, short term it's down maybe let's say 20 or 30%. If I'm convinced and I know for a fact the stock will go up, it just might continue trending down, I'll usually wait for it to go maybe even 50% and as low as 60% and then double down on that stock to cut back my loss. I know a lot of people like the 7% rule where you sell no matter what. When I first started trading, of course I was a fan of that, but after a while I've kind of realized you miss out on a lot of stocks if you sell no matter what at 7%, but that's just personal preference. The next benefit of being able to have your account on margin is the fact that you can really diversify your portfolio a lot more easily. Since you have that much more purchasing power to work with, you can now start diversifying your portfolio and selling off your losers, keeping your winners, and putting more into those stocks. The next benefit I see is the fact that you really don't have to pay this every single month or have a set payment to pay them back. Unlike a typical let's say line of credit or credit card, you have to pay that back every single month. With this money that you're borrowing, you actually don't have to do that. You can keep trading and trading and trading, and they'll take a little bit of an interest charge. But the best thing about that interest charge is actually tax deductible. However, with all this opportunity for greatness, there's also a lot of risk involved. And the main risk being that if a stock goes down and your account's on margin, it can go down really, really fast. And on top of that too, you also have to pay interest. It's an easy way to wipe out your account. Hence why there's a law stating that you need to have at least $2,000 in your account in order to put it on margin, just to protect you guys. And because of that, you can actually get a margin call. And even if you say had this stock and you would go up, but you put it all in one go and it dropped 50% and they're like, hey, we're going to sell your stocks no matter what. So that way you can afford to pay us back, because we know if it goes down any further, you won't be able to. And then boom, you lose all that money, and it's honestly heartbreaking if you see a week later the stock trends back up to higher than when you purchased it at. So I would do a lot of risk management when trading these stocks when your account is on margin. Some things that I like to do, I like to leave a little cushion of cash. I don't use all of it in one go, and typically I only like to use the margin portion. In my previous statements earlier where I said if a stock trends down, I'll usually try to double down on it. So I hope you guys liked the video. If you want me to make another video about risk management, I could do that. Or whatever type of videos you guys want to see in the near future, leave a comment below. But as always, remember to leave a like, comment, and subscribe for more future content.